Imagine being able to take advantage of a major market event, such as an FOMC meeting, CPI numbers, or earnings reports, without actually being in a trade and risking your capital during the event itself. Well, our professional traders do this all the time. And in this video, you'll be learning how you can use the hidden power of options to do just that. I'm Mike Bellafiore, and we're one of the top proprietary trading firms located in New York City and proud to have developed numerous 7 and even 8-figure per year traders. We hope you agree this is the #1 YouTube channel to help you grow your trading account.
Hi, I'm Seth Freudberg, and I'm the head trader of SMB Capital's options trading desk here in Manhattan. And it seems like just about every week there's some major market moving event, whether it's the monthly CPI report or the monthly jobs report or an FOMC interest rate announcement. And every once in a while, a major report or event or situation is so obviously going to move the market that it constitutes a major trading opportunity. But the problem is that if you try to get in before the announcement's made and you pick the wrong direction, you could get really badly hurt, sometimes in seconds, and recovering from that one hit could be a painful, long, and tedious process. But suppose that there was a way to profit from the fact that the market is anticipating that event without actually being exposed to the event itself. In other words, suppose that you could book your profits from the event before the violent market moving event actually takes place. Well, believe it or not, options traders have a strategy which does exactly that, and that's what we're going to be teaching you in today's video. In order to understand how this strategy works, we need to make sure that everyone watching the video understands how index options work, and so we're going to do a really quick review of them, and then we're going to jump right back into the details of the strategy. And so the best way to understand index options is to think of them as bets. What are known as call options pay off if an index closes above what's known as the strike price of the option on the day that option expires. If the index does close above that price on expiration day, then the call buyer gets $100 per point that the market closes above that call strike price. A put option is the exact opposite. It pays off if the market closes below the strike price of the put option. Again, $100 per point that the market closes below the strike price of the put. So for example, if an index closes at 40.32, then the 4,000 call would pay $3,200, as you can see from the calculation, because the index closed 32 points above the strike price of the call, which is 4,000. However, the 40.75 call would expire worthless, as the index didn't close above 40.75, so the call seller just pockets the premium. And the puts are just the opposite. If the market closed at 40.32, then the 40.75 put would be worth $4,300 because the market closed 43 points below the put strike price of 40.75. But the 4,000 puts would expire worthless because the market didn't close below that 4,000 strike. Okay, so with that said, I'd like to give you a pretty vivid example of how this strategy works. And so let's head back into 2016, when the British government had announced that it was going to hold a referendum to take place on June 23rd of that year to decide if Great Britain would remain in the European Union, the EU, which was a very scary proposition for the financial markets at that time, as it was seen as possibly leading to more withdrawals from the EU by other countries, which would have had a very unpredictable effect on the world financial markets. And so what options traders have noticed over the years is a tendency for the options market to get more and more nervous as the major market moving event approaches, and that very nervousness itself is actually a tradable event. So let me show you how this works. So remember, I told you that this referendum was going to take place on June 23rd, 2016. And so what a lot of traders do is, when they want to employ this strategy, they start about a month earlier, which in this case is May 23rd, 2016. And so let's take a look at the S&P 500 index on that day, which trades under the ticker symbol SPX. And as you can see, the index was channeling very consistently between 2,000 and 2,100 for the 2 months prior. And the general consensus in the market at that point, which is often the case leading up to a major market moving event, is that there's a pretty good likelihood the market will not make really any big moves prior to the big event, but is most likely going to break out in one direction or another after that event takes place. And so he opens up his broker platform and finds an options chain that expires right before the big event. So that would be, in this case, the June 17th options chain. And simultaneously, he finds an options chain that expires after in this case, the Brexit referendum, which is the options chain expiring on June 30th. And he executes the following options trade. He sells 10 of those 2,100 calls right around where SPX has been hitting resistance, and he does so on the June 17th options chain. And simultaneously, he buys 10 of the 2,100 calls expiring on June 30th after the Brexit referendum. And at the same time, he heads down to support and sells 10 of the 2,000 puts, again on the June 17th chain, and buys at the same 2,000 strike 10 puts expiring on June 30th. And so this formation, a short call above the market price and a short put below the market price in 1 week, and a long call and long put at the same strike prices in a later week, is known as a double calendar options trade. And it is one way you can take advantage of how options respond to impending major market moving announcements without being exposed to the dangerous and erratic moves that come along with those same announcements. Now, let's take a look at how much it would cost to enter this trade. And as you can see, we'll start with those 2,100 calls that we're buying on the June 30th options chain. And as you can see, those went for $11.90. But remember, each option pays off at $100 per point. So you multiply that by 100, and we bought 10 of them. So the total cash outlay for those calls was $11,900. And with that same logic, we paid $23,850 for the puts. Now, at the same time, remember, we're selling the options before the Brexit referendum on the June 17th options chain. And so since we're selling them, those sales of those options are reducing the overall cost of the position. And as you can see, using that same cash flow logic, the calls brought in $52.50 and the puts brought in $13,900, netting the overall cost of the position down to $16,600, which is the maximum possible risk on the trade. Okay, so now let's move to June 16th, the day before the options we sold expired. And as you can see, as we suspected, the SPX index, while originally pushing a little bit above that 2,100 resistance area, fell back into the channel. And finally, by June 16th, it was inside that channel. So let's look at how our position is doing on that day. And as you can see, the short call and the short put have both shrunk down to really pennies when they were originally sold for $5.25 on the call side and $13.90 on the put side. And given that it is 12:30 Eastern time, the day before those short calls and short puts will cease trading and ultimately expire, there are only 3.5 hours left for the index, which is trading at 2064, to rally 36 points up to 2,100 or to sell off 64 points down to 2,000 for either option to have any value when they expire. And so both of those are big moves and unlikely to happen that quickly. And so the market has just depreciated those options down to pennies. But then you need to look at the long options. And as you can see, those have maintained a great deal of value. And so the crucial question is why? And the reason is that those long options are still exposed to the Brexit referendum event. And so they must maintain a lot of value because the big event, the referendum, is going to take place 7 full days before they expire. And so their value is going to be greatly pumped up by the potential big move that everyone is expecting off the Brexit result. And so that retention of value of the long options, or what is known as heightened implied volatility to options traders, is priced into the long options. And that is the secret as to why this trade works out so successfully so frequently. You see, the short options have to lose value and ultimately dwindle down to zero if they don't appear to be likely to expire in the money. But the long options have to retain their value, particularly with such a big event coming up. And so in the ideal double calendar, the short options lose value, which you want them to do because you sold them and you're short those, while the long options maintain substantial value, which is very likely to happen if those long options are still exposed to that big upcoming event. To close this position, all you need to do is buy back the options you're short and sell the options you're long. And so let's take a look at how that would calculate out. And as you can see, we'll start off with selling off the long options that retain most of their value, as we just discussed, and using the same math to calculate the positive cash flow from the sale of those options. You can see that we brought in $13,750 for the long calls and $15,300 for the long puts. So obviously a large amount of cash value is still left in those options, while buying back the short calls and the short puts was extremely cheap, $130 and $250 respectively, which makes sense, as we just explained. The market has just run out of time to impact those short options, and they're not exposed to the major market moving event, the referendum. So they've got to close with no value. And so when you net it all down, the final result of the trade is a profit of $12,070, which is a return of more than 72% in less than a month. And so what I'd like you to take away from today's video is that options give you the incredible ability to take advantage of a market moving event in a way that you might find hard to believe, because you can be out of the trade with a tremendous profit without your trade actually being exposed to the volatile event itself. And that is because in the case of a double calendar, the options that are exposed to the event hold their value, while the options that expire before the event are forced to lose their value, resulting in a real edge to trade. Professional options traders have strategies like these and many, many more that they can draw upon depending upon the multitude of different situations that the market can present at any given time.
Okay, it's great to be able to take advantage of major market events, but you may want to know how to make consistent cash flow month in and month out. Click the video appearing on your screen right now to learn an easy technique that can produce consistent cash flow from one of the most popular investment strategies, covered calls.